Thanks for tuning in. Wealth Quest here, and welcome to my July Dividend Growth Portfolio update. This is a series of episodes I do on a monthly basis to show my portfolio value, dividends received, performance, and much more. So if you want to follow along this journey and see my future updates, all you have to do is subscribe. Let's dive into the numbers. Starting off with the high-level numbers for July. The total portfolio value is sitting at $41,758. The weighted dividend yield right now is coming at 2.25%, which translates to $734 in projected annual dividend income. Seeing that patty number climb is one of the main goals here. That's $734 a year coming in passively, purely from staying disciplined and letting the strategy work. To put that $41,000 value into perspective, it helps to look back at the trajectory over the years. Going from under $2,000 back in 2020 to past $41,000 today really highlights what consistent contributions and dividend reinvestments do over time. In the beginning, the growth feels painfully slow, but once you start compounding, every single year adds a bigger chunk than the last. We are already up over $8,000 from where we ended in 2025, and the momentum is just continuing to build. Now, taking a look at how the portfolio performed this month against the broader market, July was easily the standout month of the entire year so far. The portfolio surged by 8.73%, practically running neck by neck with the S&P 500's 8.90%. A common critique of dividend growth investing is that you sacrifice performance and miss out when the market pulls off massive rallies. But posting nearly a 9% return in a single 30-day window shows that you don't have to choose between solid passive income and serious capital appreciation. Honestly, in my opinion, the broader market is getting pretty overstretched, largely driven by a handful of AI companies that are pushing valuations to levels that feel due for a correction. If you pull back those heavily inflated mega cap AI stocks, this portfolio would actually be outperforming the market. That's why I stick to the strategy. By keeping the focus on high-quality dividend-paying companies, we get plenty of horsepower to capture massive upside during runs like July without taking all of that concentrated risk if those overhyped tech valuations start to pull back. Next, let's dive into the current breakdown of the entire portfolio and how these 21 holdings fit together. Right now, the top half of the portfolio is anchored by major positions like Alphabet, Microsoft, S&P Global, MasterCard, Automatic Data Processing, and Visa. When you look at these top allocations, it's easy to see how this portfolio is structured. This isn't just a traditional high-yield income portfolio where you sacrifice all capital growth for immediate payout. This is built specifically as a dividend growth portfolio with built-in alpha engines and downside protection. The tech and payment networks like Google, Microsoft, Visa, and MasterCard give us that growth and market beating potential, the alpha that compounds our overall capital much faster over the long haul. At the same time, we balance that high-end growth with high-quality dividend compounders like Texas Instruments, JP Morgan Chase, and Hershey's, alongside battle-tested defensive names like Johnson & Johnson, AbbVie, Kroger, Pepsi, and Waste Management. These positions give us the crucial downside protection when the market gets choppy, ensuring that even if tech takes a breather, our passive income engine keeps chugging along uninterrupted. Every single stock in this lineup serves a purpose. It's a strategy engineered for longevity, designed to give me a real shot at beating the market over full cycles, accelerating the compounding speed, and ultimately hitting my long-term targets. When it comes to my buys for July, I kept the focus tight on double-digit dividend growth compounders. I added 0.61 shares of S&P Global, 1.18 shares of Microsoft, and 0.11 shares of MasterCard. None of these three are high-yield plays right now, but that's entirely by design. What they give the portfolio instead is explosive dividend growth potential and massive capital appreciation engines. Adding to high-quality compounders like Microsoft, S&P Global, and MasterCard ensures that my dividend payouts don't just grow, they compound at an accelerated rate over time, driving up our yield on cost and continually raising the floor of our passive income. Before we talk how much I got paid in July, it's worth taking a second to revisit why dividend income is the backbone of this strategy. Dividends represent real tangible cash flow generated from actual business profits. Unlike paper gains, which can evaporate overnight, whenever the broader market decides to pull back, a dividend payment is cash on hand. It provides a steady, reliable return on investment regardless of short-term price fluctuations or market volatility. More importantly, every single dollar received is a new unit of capital that gets put straight back to work. Reinvesting these payouts buys more income producing shares, creating an automated compounding machine where your money literally generates more money without you needing to trade hours for dollars. For the month of July, I had 6 companies to pay out cash dividends directly into the account. Realty Income $5.94, Colgate $4.44, MasterCard $4.57, JP Morgan Chase $8.93, AbbVie $10.41, and Procter & Gamble $3.29. That brings our total passive cash flow for July 2026 to $37.58. $1.58, and year to date, $410. While $37.58 might not sound like a life change on its own, it represents real progress. That's nearly $38 of income generated purely by holding great businesses. When you combine these monthly payouts with my consistent capital contributions and organic dividend growth, every single month sets a brand new higher baseline for my passive income. To really understand how compounding works, you have to zoom out and look at the year-over-year trajectory for the month of July. Back in July 2020, this month brought in just a couple of dollars. Fast forward to today, and that single month generated $37.58. July is one of my low-paid months, but when you look at that progression over the years, the number consistently move up and to the right. It's proof that the strategy works. It isn't an overnight explosion. Every single year sets a brand new floor for your passive income. When you look at the annual payout breakdown across every position, you really see how the income responsibilities are divided up across the portfolio. Right now, a heavy chunk of my baseline income is carried by a few core high-yielding dividend engines. These heavy lifters do immediate work of pumping cash back into the account every single quarter, giving us reliable capital to reinvest right away. On the other end of the spectrum, we have low-yield, high-growth names. On paper, their annual payout number look relatively small today, but those are compounding accelerators. They might not pay out massive income right now, but their payouts are growing at a rapid double-digit rates, while driving the vast majority of the portfolio's capital growth. Having that mix is key. The high-yield positions give us immediate cash flow for today, while the lower-yield growth engines ensure our overall income expands rapidly into the future. Next up on the screen, you're looking at the breakdown of total capital invested versus overall gain or loss across every single position. I put this chart together specifically for full transparency, so you can see exactly where every dollar sits, win, losses, and everything in between. Looking across the portfolio, the vast majority of my holdings are firmly in green territory. We have major winners like Alphabet, JP Morgan, Apple, and Texas Instruments that have generated massive capital gains, in some cases more than doubling the actual cash I put in. These huge gainers serve as the primary growth drivers, pulling the portfolio forward. At the same time, keeping it completely real, we do have a few positions showing red right now, like Hershey's, Nike, Pepsi, and S&P Global. That is simply part of investing. When quality companies trade at a temporary discount due to short-term headwinds, I don't panic. In fact, those red positions are often where the best long-term buying opportunities sit, allowing us to lower our cost basis and lock in higher yields for the future. Showing the full picture, both the huge green runs and the temporary red pullbacks, is key to stay disciplined and tracking true, honest progress over time. Finally, let's take a look at the total return across the portfolio. Total return is where the power of dividend growth investing shines because it factors both capital appreciation and every single dividend paid out since opening each position. At the top end, our heavy compounders have delivered huge results. We have multi-baggers like JP Morgan Chase, Apple, and Alphabet, which are up anywhere from 100 to nearly 200 overall. Following right behind, there are core holdings like AbbVie, Texas Instruments, and Johnson & Johnson, sitting up from 50 to over 70%. When your growth drivers deliver double and triple digit gains, they elevate the net worth of the entire portfolio. Then we have a large layer of solid, steady performance names like Waste Management, Starbucks, Visa, Colgate, and Kroger, all delivering solid double-digit total return. They might not jump to 50% overnight, but they steadily move the needle month after month while consistently raising their payouts. Of course, keeping it completely transparent, we also have our pullbacks. Nike is down over 40%, alongside temporary dips in Hershey's, Pepsi, and S&P Global. But their return reminds us why we stay patient. While short-term prices fluctuate, those dividends keep rolling in, compounding behind the scenes and positioning us to win big when these quality names turn around. That will be it for the July Dividend Growth Portfolio update. Thank you so much if you made it till the end. Don't forget to like and subscribe for future updates. Thanks for watching, and I'll see you in the next one.